Hi guys, my name is Davi Almeida. I'm a professional hedge fund manager here in São Paulo, Brazil. And today I'm gonna interview Dr. Jim Schultz. Dr. Jim is a show host at Tastytrade, as well as a PhD in finance and a great options trader. Hope you enjoy the interview. Trade. I want to thank you first for the opportunity for the chat here today. And I want to congratulate you for the amazing job you guys are doing. And I really like the series you did with Kai because I'm a fund manager here. I used to manage stock funds here. But in stock funds, you can't trade too many options because they're always looking at the notional. You have to be long stock. There are some rules. But recently, I started a hedge fund. In a hedge fund, you have much more flexibility, and that was really helpful in managing the portfolio. How much is the right leverage for you to take? But first, Jim, I'd like you to introduce yourself, to talk a little bit about how you started in options and how you started in finance. We know you're a great options trader, but you're also a great options teacher. Talk a little bit about your journey to options.
Oh, well, thank you, man. I appreciate that. I appreciate all that, and thank you for the support of my show, my content, and then of course Tasty Trade as a whole. That's really really awesome. And so, yeah, I was one of the unique cases where when I started college as a freshman, like I knew exactly what I wanted to do. I knew exactly what I wanted to do from a subject matter standpoint. Like once I chose finance, I went straight through. I never changed my mind. I never wavered. And I know that for most young people, that's a little bit unusual. Like usually they bounce from one to the next or whatever, which is perfectly fine. But I was a unique case where I just went straight through. I knew it was going to be finance. But I actually thought that I was going to be a stockbroker. I really wanted to be a financial advisor for most of my undergraduate career. And then between my junior year and senior year of undergrad, I did an internship at Raymond James, actually, which is a very popular brokerage firm here in the US. And I had a great time. Had a great time. I really got to know, the business. I really loved my bosses or potential bosses. And when I got done, they said, "Hey, just go graduate. You've got a job." All those different things. But the one thing that I didn't really love about the role of a financial advisor was it didn't really have that much to do with what you knew about finance. It actually had a lot more to do with your relationship skills and your people skills and your ability to kind of build and foster these relationships, which is fine. It's perfectly fine, but I really just loved the finance aspect of it. And so that then kind of sent me in a different trajectory in terms of my career. I wanted to continue on with my schooling, so I stayed at Central Michigan University for my MBA and then went down to the University of Memphis for my PhD, and then I graduated in 2009 and I started my career as a professor. And so my career started as a professor in the classroom, teaching undergraduate and graduate students, finance, principles of finance, investments, all these different courses. And I loved it. I absolutely loved it. But then when I found Tom and I discovered Tasty Trade, and I was like, man, like what they're doing over there is super unique and it's super innovative. I'm like, I kind of want to be a part of this. And so then in 2015, my career took another turn where I was like, okay, I think I'm going to leave the classroom and I'm going to join the team at Tasty Trade. And so that's basically how it happened. And it's crazy to think now I've been on air with Tasty Trade for over 6 years. And so from theory to practice has been going strong. I didn't know if I'd make it a year. And so here we are 6 years later. And yeah, that's the basic idea. That's the basic Cliff Note version of how I arrived at the spot I'm at now.
All right, cool. You guys are doing a great job there. Not only Tasty Trade, but Tasty Works also actually, but because a lot of Brazilians are opening accounts at Tasty Works. A lot of people are trading. Options are becoming uh, more and more popular here in Brazil. I'm sure in the US too. And Tasty Works are a very unique and singular type of broker. Um, Gene, you talk a lot about the building blocks series, the crash course, and a big question that people have here is when you're selling options, how much is too much? What is the right amount of leverage you need to take? You talked a lot about the portfolio data as a measurement, a right measurement of leverage, the right leverage. How much buying power should I use? To measure the buying power, is the right way to measure the right amount of options you can sell? So this is a big question I always had. You're the first one that talked a bit about that. And what can you say to us about that?
Yeah, so that's a really, really good question. And yeah, I do have a couple of insights that I can share to hopefully help out your audience and help out your viewers and help out, the people that will kind of hear this video. So number one, I do think that portfolio theta is a great guide when it comes to understanding and managing your risk. And so this is why we like to target certain levels, whether it be 0.1% of net lick, that's extremely conservative, or maybe up to like 0.4 or 0.5% of net lick. That would be a lot more aggressive. And then most people are going to be somewhere in the middle, 0.2%, 0.3%, whatever. Because when you do that, what naturally happens is if you're, targeting, let's say 0.2% or 0.3% of net lick in portfolio theta on a daily basis. So just to give everybody some numbers, if you had a $100,000 portfolio, 0.1% would be $100 per day. 0.2% would be $200 per day. 0.3% would be $300 per day, and so on and so forth. When you do that, that alone, Davey, that controls the portfolio risk in such an effective way. Like that one thing that you can do that is going to really mitigate your overall unit risk across the portfolio in a really, really big way. So I would strongly encourage everybody to continue to do that and find what level is best for them. It's not a better or worse thing. It's a gimme and gotcha thing, which is what I talk about on my show all the time. Like, if you want more theta, that's fine. You just have to understand that you are going to have a bumpier ride. You are going to have bigger swings, wilder fluctuations, and all those things. When it comes to a buying power reduction standpoint specifically, here are a couple of things to think about. Number one, with defined risk strategies, I mean, it doesn't really matter as much. I mean, it does matter if they're super huge, but like with the defined risk strategy, the risk is already defined, like, the worst case scenario on entry. So, usually keeping those trades, 1, 2, 3, 4, 5% of your whole portfolio per trade is going to be perfectly fine. And of course, if you have a larger account, that's easy to do. If you have $50,000 or $100,000 or larger, that's very easy to do. If you have a smaller account like $10,000 or $7,000 or $15,000, that's harder to do. You may have to be a little bit higher when it comes to your buying power reduction. It's the undefined risk trades where you have to be really, really careful. And so here, somewhere between 3 to 7% of your net lick in one undefined risk position. And of course, the smaller, the better. But again, it's kind of constrained by the account that you might be using and the size of the account. Where, again, if you have a $15,000 account, you're not really going to be able to find too many 3% opportunities. It's just not going to be available for you unless you never trade anything other than, SLV or GDX, right? I mean, you have to find some other things to trade, right? Exactly. From an overall portfolio standpoint, though, how much capital should I have allocated? That's another thing that depends on a lot of things. It depends on how much time you have to allocate to your trading. It depends on how skilled you are, how much experience you have. It depends on how risk averse you might be. Are you more risk averse? Are you less risk averse? Like, these things matter, but most traders tend to be somewhere around 30%, I would say, allocated on the low end to maybe 65 to 70% on the high end. So just to give everybody kind of a range. Right now, some traders have more allocated. Some traders are closer to being maxed out, 80%, 85%, 90%. That certainly does happen. But I would say 30 to 35%, all the way up to 65 to 70% is a good range that people can kind of operate within. I understand it's a big range, but it's an impossible question for me to nail down to like, okay, everybody should do this. It's impossible to say without knowing a certain person's specific circumstances.
Yeah. I think what you have in your portfolio also is a factor that you need to measure, because if you're long stock, if you're 100% long stock in your portfolio, maybe you should sell less options. If you have only have cash, maybe you should go a little closer to 0.5% of data. And I think this is something that you should consider as well. Mm-hmm. And you should What about naked calls? You think you do sell more puts than calls? You go naked on the call side. You just do covered calls. Of course, then when you're talking the ETFs, maybe you can maybe sell naked calls, or maybe not only on stocks. Yeah, you do sell naked calls.
Yeah. So naked calls are kind of tricky. Like naked calls are an interesting thing because naked calls all by themselves. So that's the only strategy. That's all you do. It's not part of a strangle where you have a naked put. It's not part of a covered call where you have the long stock. It's just a pure naked call. It's not really something that I like to do too often. And the reason why is a couple of reasons. So number one, I'm just generally more bullish in nature, which is kind of more rare inside of the Tastytrade universe. A lot of tasty traders and a lot of the other hosts on the network are more bearish and they like having short delta and all those things. I've tried that at different times in my career. It never really made sense to me. It never,
Like
I always felt like I was, we can talk about that some more if you want to, but it always kind of felt like I was just trying to square a circle. I'm like, this doesn't really make sense. I mean, the market wants to go higher over time. I mean, geometric boundary in motion, positive risk premiums, innovation, creation, global growth. I mean, for all these different reasons, the market wants to go higher over time. So I'm like, I would much prefer to play that side of things. So given that, and also given the fact that we like to adjust our positions and we like to roll our positions over time if we need to, I never really loved the idea of having a naked call on that. I'm like, all right, man, like I'm going to have to potentially fight this thing for a long time against a rising tide. Like, anybody who sold calls in Tesla the last 3 years, like they're out of business now. Like it's over. Like it's done, right? Like if you sell calls in certain stocks, like you're really playing with fire. I mean, people who sold calls in GME, like, man, I mean, I answered some crazy emails, Davey, like some crazy emails, man, like some serious stuff. I'm like, man, that's just, that's tough. And so I really, really don't like to do that because it doesn't make sense, especially when there are so many other strategies that you could do to achieve similar results. And so naked calls for me, I'll do them from time to time. Like if I kind of feel like, all right, this might be a one-off situation where a naked call is the right fit, playing a bearish bias. I really want to have, more delta to the downside. And that's just how I see this one play. But as a regular, consistent occurrence, it's not really something that I like to do. No.
Yeah. I think the same way. I pretty much, I'm kind of bullish myself. And like Kai Zhang, he's much more bearish than us, I think. I talked to him, such a great guy. And what about the Tastytrade mechanics? You follow those strictly. You do the 45 days, closer to 45 days. 21 days is you just roll or close the positions. It seems to me like a pretty smart way to keep you calm, to know exactly where you need to go. You follow those mechanics strictly, perfectly.
I wouldn't say perfectly, and I don't think anyone does it perfectly. Yeah. But yes, like as a really, really good guide to follow, and for all the trading I do on my show, From Theory to Practice, like show the portfolio every day and kind of show everybody what I'm doing. Like yes, entering at 45 days to go, exiting at 21 days to go, especially with undefined risk trades like a short put, like a short strangle, like maybe a short call if you had one on or whatever. Getting out at 21 days to go just makes a lot of sense because then you can avoid any excess gamma risk that might come alongside the trade as you get closer and closer to expiration. The 21 days to go rule, though, and this is something that a lot of people kind of get hung up on, and this might really help your viewers and your audience. The 21-day rule, it doesn't really apply to a defined risk strategy, though, like a vertical spread or an iron condor. And the reason why it doesn't apply is because there really isn't any gamma risk with those strategies. So if you think about those strategies, right, they all have short units that are covered by long units. That's how they're defined risk. And so if my risk is defined like that, then I'm in a situation where I don't really have to worry about avoiding gamma risk. And so if I can't get out at 21 days to go, or I can't roll at 21 days to go for a price that I feel good about, like a credit or whatever, then it's okay to carry those trades inside of 21 days to go. If you can get out at 21 days to go, and you're happy with the profit, then by all means, go ahead and get out of that vertical spread or that iron condor or that butterfly or whatever. But if you can't, it's absolutely okay to carry those trades inside of 21 days to go. But when it comes to the mechanics, 45 days, 21 days, rolling the untested side, all those things, that is what I do. And I try to follow it to the best of my ability. But as I say on the show all the time, you have to blaze your own trail. Like, there is no black and white manual for trading. And of course, you know this very, very well with all of your experience, managing a fund and now having a hedge fund and all these things. There's no one size fits all solution for every single person. It doesn't exist. And so I think it would be disingenuous to pretend that it did. And so instead, it's like, all right, we've got these 4 or 5 or 6 different things that we all kind of agree on that are universal principles that will certainly help you. But how you then take those and shape those and tweak those to kind of fit your own style, your own risk appetite, your own risk tolerance, your own, time and resources that you can devote, that's going to be unique to every single person.
Great, Jim. Perfect. People are different. I agree with you 100%. Those defined risk trades, maybe if you're in a vertical or put vertical spread and it's completely underwater, I think it's a good idea just to close the trade. Or it doesn't seem to me like a smart idea to roll for debit in this case. So defined risk is just I just close the trade and assume the loss. You feel the same way or no?
Well, yes, I do. So if you're at 21 days to go and you have a vertical spread on and it's fully underwater, and if you want to roll that out to the next cycle, you have to pay a debit to do so. I, like you, I'm not going to roll for a debit in that scenario. It's maybe every once in a while, and if I ever did do that, I would have a good reason why I'm kind of violating the rules. But most of the time, I'm not going to roll for a debit, because when you roll for a debit in that scenario, you are adding risk to the trade. Like, that debit is increasing your maximum loss. And so you need to keep that in mind. That is very, very, very important. So your max loss was $300. You just roll for a 30-cent debit. Now it's $330. And so you have to understand that that is indeed changing that number. So I don't like to do that. So what I'll do in that situation is just hold the trade. Just hold the trade all the way to the end if I have to. And then if it never comes back and expiration comes, then yes, you just close the trade and you're done with it. I don't like to close it out early at 21 days to go, though, because I'd rather hold the trade and see if it can come back. Now, of course, there's a give and take there too. If you close it out at 21 days to go, you may save a few pennies off of max loss, of course, and some people like to do that. And I respect that. I think that's certainly a way that you can do it. But I like to let the probabilities play out for the whole time and just kind of play it that way.
Yeah, great. You talk. I think you like the ratio spreads, right? You said a lot. You're a big fan of those strategies. I like to myself. Here in Brazil, we call booster. No one calls ratio spreads. We just call the booster. It's the same
booster.
Trade. Booster. Say, like, you're boosting a covered call when you do it with calls. Some people call a asymmetrical spread too. But since you're an expert in the ratio, how you set up? Can you give us any tips? How you do it? What deltas do you use? What kind of how exactly you like to do this strategy specifically?
Yep. So I'll give people a couple of things to think about when it comes to the booster strategy. I love that. I may start using that. That's really good, because that's exactly what it kind of is. That's really cool. So here are a couple of things to think about when it comes to a ratio spread. I almost always use put ratio spreads. I don't usually use call ratio spreads, for the same reason that I don't like to have naked calls, because that's effectively what you have on with a call ratio spread, the extra naked call. I don't like to get into that for all the reasons we've already talked about. So I normally do put ratio spreads. Okay. With a put ratio spread, there's kind of 2 different ways that you can play this. You can play it in a way that's going to be a little bit more, let's call it Tastytrade approved. And then there's going to be another way that you could use them that's maybe not so Tastytrade approved. So don't let Tom know that I shared this with your audience. But I want to give you guys some things that maybe you can't find anywhere else. So number one, if you do kind of the Tastytrade approved ratio spread, which is very effective, and this is what I do on my show all the time, you're going to want to enter the trade around 45 days to go, exit the trade around 21 days to go. Just pretty standard short premium situation. You wait for high implied volatility. You wait for high implied volatility rank. You sell that premium, and you're putting yourself in a really good spot. One of the ways you really want to utilize that strategy is consider using very narrow strikes. So, maybe only $1 between your long and your short, maybe only $2 between your long and your short. And the reason why you want to do that is if you narrow the distance between the long option and the short option, you're going to be able to boost the credit that you collect on the strategy. And by boosting the credit that you collect on the strategy, if the stock does rally and the options move further and further out of the money, you're going to have a greater credit that you're going to be able to cash in on because you maximize that credit on order entry. And so it's going to be a lot easier of a trade to manage at 21 days to go or when you realize a profit or whatever. That's one way that you could use this strategy. Here's a second way that you could use this strategy. If you want to deviate from the Tastytrade mechanics just a wee little bit, consider using wide ratio spreads. So you could consider going really wide with your ratio spread. And I mean like super wide, $7 wide, $10 wide, maybe $15 wide, whatever. Do this in the index products and maybe consider taking those closer to expiration. And here's the reason why. You're not necessarily going to collect a huge credit because you're widening out the ratio spread. You probably still want to bring in some kind of a credit so that way if the stock does rally, you can at least make a little something. But you can use these as a really good hedge against a long portfolio because with the super wide spread that's baked in there, that spread could bring in a nice little bonus kicker if the stock actually falls inside of your strikes at expiration, which that could be a situation where the rest of your portfolio, if it's long, is getting hurt. But this ratio spread or these ratio spreads, if you put on more than one, they can actually be profitable in that scenario where you land between the long strike and the short strike, and they can become super profitable if that happens to happen near expiration. And so ratio spreads in terms of making max profit where you pin that short strike, that can only happen at expiration. Well, again, with what we do every day at Tastytrade, if I'm in at 45 and I'm out at 21, I'm never going to be around to enjoy that, if that makes any sense. But if I widen it out and I carry it a little bit closer to expiration, you got to be a little careful with that because, you are exposing yourself to more gamma risk and things like that. But it's just a little something to think about, just a little something to kick around in the old noggin there.
Yeah, but if you're at least maybe if you're paying a little bit to do that, you're still not in a really low pop situation. Right? Your pop is going to be probably under 50%, but not too small pop, which is a bad thing. It's a really great information. I liked it. I'll try that, Jim. I'll try to do that. I like buying. I used to do a lot of long volatility closer to expirations. I think it's a smart way. If you know how to do it, you need to practice a lot. But when you're talking about just buying options, doing closer to expiration seems to me like a smarter way. Yeah, well, the research on Tastytrade show that the gamma risk, you end up using that in your favor.
Yeah, just hey, if you try that wider ratio spread, just don't tell Tom. Don't tell Tom that you're doing it, and don't tell Tom who told you to do that. So yeah, there you go.
maybe you can start another company, James Trade, something like that, and do your own trading at your own show.
You never know, man. You never know.
No, this is great, Jim. This is pretty much. I know you have a really busy schedule. Is lunchtime already in Chicago? No, still not.
Yeah, almost. I'm in Florida, so yeah, it's 12:30. We're right around lunchtime. Yeah.
Yeah, cool. Okay, Jim. Thanks a lot. It's been really helpful. Maybe we can chat again some other time. Congratulations on the show, and keep posting those on Instagram. Those tips for training and for working out. I do a lot of exercise myself. Still, I'm going improving here strength now. I'm in a phase of bulking phase now. So you really helped me a lot, Jim. Thanks a lot.
Oh, that's awesome, man. No, that's really awesome. And that's cool, man. Thanks for connecting over there too. That's one of my other loves. and passions in this world. And so, yeah, no, that's awesome. And it was my pleasure. Absolutely my pleasure, man. And, you know, if you want to do this again, I'd be happy to do it again whenever you want to. Just give me a little bit of heads up. And I really appreciate the fact that you were so well prepared and you had the questions you wanted to go through and those kinds of things. That was really helpful. But if you ever have, like, if you have a group of, you know, if you want to do a live kind of webinar with your audience or whatever and have people just chime in to ask me questions in real time, we could certainly do that too. So something like that would absolutely work too if you ever wanted to do something like that. And just let me know, man. I'm more than happy to do it.
Oh yeah, thanks a lot. No, that would be great, because people are trading a lot of options here in Brazil. A lot of people trade here in Brazil. A lot of day trades. That they trade mini S&Ps here from Brazil, something like that. But the option world here is increasing really rapidly, and it's different because the training materials, the influencers, the books here in Portuguese, they always talking about buying options, and this is a leverage. Not a lot of people are talking about selling and shorting options. So it's been like a breakthrough here. We're changing the way people look at things, and it's really nice to talk to an expert like you. Maybe we can catch up again, then do a live and some other thing another time.
That sounds awesome, man. That sounds awesome. Let me know. That'd be great.
Hey, thanks a lot, Jim. Bye-bye, man.
All right, man. Bye-bye. We'll see you next time. Okay, bye.
Thank you.